Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, Tim Little, founder and CEO of ZANA Investments. And today, if you get loans from multifamily or invest with people that do, you're going to want to pay attention to today's guest, Russell Nova. Russell is a principal at MTM Investment Group, a privately held multifamily investment company, and has been investing primarily in multifamily properties for over 5 years. MTN Investment Group is primarily focused on opportunities with a value-add component. He is also a principal at the Cornerstone Group, which is a debt advisory firm with over $1 billion in secured financing on commercial and multifamily portfolios. Today, Russell owns and operates 2,600 doors with 250 million assets under management from a KP and GP perspective with his partners at MTM Investment Group. Russell enjoys spending time with his girlfriend Kathy and their 2 dogs, a pit bull named Carmela and a Frenchie named Oscar. Russell, welcome to the show.
Ben, what's going on, man? Thanks for having me. Really excited to be here. I am always excited every time I get a chance to come on and really speak to people and share my experience and really just kind of share as much as I can about the multifamily industry. I am always excited. Always.
Yeah, well, we're certainly happy and excited to have you as well. So I gave everyone a very high-level overview of your background, but on this show, we really try to dig into your journey in multifamily. So how exactly did you get started in the multifamily space? And give us just a little bit more background on you and how you got here.
All right, so I got started in multifamily about 5 years ago. Now, I wasn't really planning on doing that. I wasn't really planning on investing, right? I thought the only really way to really do what I do was to do financing because that's where I come from. I come from a financing background. I've been financing properties for the last 10 years now. And what happened was we've been doing so much for other operators, right? And we're seeing all these other individuals doing well and buying properties and growing their wealth, because that's what it is, generational wealth. And something hit me one day and said, hey, listen, we've been doing all this good for other people. Why don't we try to learn how to purchase multifamily and do the same thing, right? Because we already have the relationships with the banks. So it was just a positive situation at that point. And a few years back, as mentioned 5 years ago, we purchased our first property. It was a 30 unit that we purchased our first property. And from there on, it's where we are now, right? We made an investment. We took a risk. We understood. We got mentors. We learned the business. We're still learning. But fast track to today, we currently own about 2,600 units collectively with our team and growing. We do have a couple of properties right now that are in contract from a multifamily perspective.
That's great. It's something that we hear a lot in terms of, people being on the other side of that table, helping multifamily investors, whether it's bankers, lenders, brokers, and they see all the money that they're making and the success that they're having, and they're like, wait, why am I only on this side of the table? Why can't I be doing this too? And it puts you in a really great position because, like you said, you're learning so much from the side of the table that you're already on, but you're also building relationships with all those folks that you've been doing business with.
Absolutely. And I also got to mention that I feel like I got a head start in this business because of my previous history with financing, right? I've been seeing so many deals. I underwrite so many deals. I analyze them, right? I work with other operators. So I got a chance to really be in this business, not knowing I was already in this business, not knowing that this is what I wanted to do by doing all the financing for every other sponsor that actually came our way.
Yeah, that's so much of an advantage versus that person who's just starting out, whether they were a doctor, dentist, whatever it might have been, and they decide that they want to go into multifamily. Having that background, even tangentially in the business, I think is huge. So you talked about that 30 unit that you guys got, which was your first acquisition, it sounds like. Tell me a little bit about what that deal looked like and how you guys were able to finance that. Was that did you joint venture on that? Did you syndicate that? What did that look like exactly?
that was a joint venture. That was a joint venture property that we purchased in South Carolina. It was a 30 unit. It was about a $2 million raise where we went out to our own individuals that we know. Now, we didn't want to syndicate where we would take investors' money. This was a trial and error for us. Obviously, it was more than a trial and error, but we wanted to make sure that we understood the process, right? Because the real work doesn't start until you close. The closing part is essential on its own, but once you purchase the property, that's when the work starts. Your budget, your CapEx project, interior, exterior. We really wanted to just make sure that our family and friends believe in our product first and in our process before we went out into the market and really got other investors to come in. It was a great property. We purchased that property for about $4.5 million. We were very excited about it. The market of South Carolina is great. There's lots of opportunities there. The rent growth, the job growth, the population growth, everything was in an upward trajectory. So we were happy about that. And fast forward, we held that property for about 18 months, and we returned about a 2.2 times multiple to our family and friends.
I really appreciate that you said that once the closing happens, that's when the work really starts, because I think that's a misconception that a lot of people have. They think, oh, I got the deal over the finish line. We closed. Hooray. I'll put it out on social media and everybody lives happily ever after. Now, don't get me wrong. Like, sometimes closing does seem like mission impossible. You've been with me there a few times where we just didn't even think that was going to happen. And it goes right to the last minute. But like you said, it's all about that business plan, and you don't start implementation of that business plan until you close. So I really appreciate you mentioning that, because I think so many investors gloss over it, and passive investors don't really understand that as a key concept of this business.
Absolutely, and I'll just point out one thing. It's when we close, we kind of celebrate for that. Maybe a few hours, maybe like 5-6 hours a day at most. We celebrate, right? We're happy. We post pictures, but then it's kind of like the following day. Okay, what do we do now? How do we get everybody involved? How do we get everybody to concentrate on this property? So, it's more or less, it just flies by. It's like it just flies by.
Yeah, exactly. And you mentioned Cornerstone Capital at the beginning, and that's the lending piece of what you do. Obviously, you're a very busy guy. When it comes to Cornerstone Capital, what exactly do you provide for the customers, and what would you say is your competitive advantage in that space?
So Cornerstone Capital is a debt advisory firm, and we specialize in financing multifamily properties across the states. We're online with about 85 different banks, and when I say online, we have that direct relationship with decision makers, and we work with tremendous amount of owner operators within our community. And when I say community, I say the multifamily community. So we've had the pleasure of really guiding and working through the process. Now, what makes us a little bit different is the fact that we're not fee driven, right? Our model is a bit different. We have about 12 to 15 advisors here in the office, with a loan coordinator, an analyst, a credit manager, and a chief operating officer. Our model here is not fee driven. Our model here is to really do the job, analyze, underwrite, guide, and work together with a sponsor to ensure they're getting the best product and rate, and really put them with the correct lender for the project, right? Every lender is specific to what they want to see in a project. There are lenders that don't touch anything that's 5 million and under. They won't touch it. There are lenders that won't touch anything that's below a 1970s product, right? They won't do it. So it's really important to understand the type of property and product you have in front of you. And that's what we kind of have grown over time. We understand what's in front of us. We understand how to underwrite, how to analyze, how to put things together. We help out with the offering memorandum. And most importantly, we work through start to finish with the operator to the closing table, because like you said, sometimes it can get frustrating, it can get tedious, but no matter what, our main objective is to ensure that every sponsor gets to the closing table.
So I don't know if I'm oversimplifying here, but would it be accurate to say that you're a mortgage broker?
Yeah, Absolutely.
Okay.
Yes, you could actually say that, right? I'm kind of using a little different terminology, right, to sound a little better, let's just say, right? So, a mortgage advisory firm, but yes, we are a mortgage brokerage. So we are a mortgage broker.
Okay. Yeah, because we got people of all different levels listening here, so I just want to make sure that we're clarifying and maybe relating the terms that they need to be familiar with. Another term that you brought up earlier that I just want to make sure the audience understands is you said on that property, that 30 unit, you were able to get your investors a 2.2 equity multiple. Why don't you talk through that, what that means, and how that might be relevant to, say, like new passive investors?
Yeah, so a 2.2 multiple is more or less you put an X amount of dollars and you would get back 120 times down on those dollars, right? So if you put in 100 and let's say you put 100,000, you would get back $220,000, right? So it depends on how many years we're in the deal, but we were only in the deal for about 18 months. So their internal rate of return, their IRR, was phenomenal, right? Because we're only in it for 18 months. So their total return, 100,000, they're in it for 18 months. They got and they got 2.2 times their money back. So it's roughly about, if I'm not mistaken, I can remember correctly, it was roughly about a 35% return in 18 months. So if you ask me or any other investor or any other operator, a 35% return in 18 months is healthy on its own. So
Yeah.
I think
And I
that's
think
healthy as well.
I think that's really important for especially new investors to understand, because there's so many terms out there as they're, in terms of the metrics when they're looking at these deals. And myself included, when I first got started, I didn't really know which metrics were the most important. But I think now that it really comes down to whatever the goals of that investor are, right? Like if they want cash flow, then the cash on cash might be more important to them. But someone who's just looking for overall returns, well, yes, I'd rather get a 2x, multiple on my money, especially if it says I'm going to get it in 3 years versus a similar deal who offers a 2x return in 7 years, right? So people really need to take into account that time value of money and not get so hung up on it has to have this cash on cash and this IRR. They really, I think, need to understand what their own investing goals are so that they're not using, something that's too rigid to evaluate deals. What are your thoughts on that?
Fully. I think that every investor has their own specifics on how they want to invest. Usually the class A properties, which are the newer type properties, will have a much less, a lesser cash on cash versus initial rate of return. But in my opinion, when I look at deals and I invest into every single deal that I put under contract, right? That is our goal. That is our motto. So we're not just putting deals together. We're putting our hard-earned sweat into every single deal. On top of that, we're investing in our own deals. So for me, I want to make sure that when I put in my money, the faster I get it back, the faster I can redeploy back into the market. So what I look for is my initial rate of return as well as my equity multiple. Now, from an underwriting perspective, we're always underwriting from 5 to 6 years. In the event the market doesn't work in our favor, we're able to hold a property, but still return the same amount of returns to our investors as indicated in the offering memorandum. Now, it's only sweeter if we get rid of the property in, say, 18 to 36 months, because guess what? Their initial rate of return gets higher because they get the money back faster. And on top of that, their equity multiple, because now they're getting their money back a lot faster. So you're doubling your money, hopefully, right? That's the goal. You're doubling or even higher. I've seen it happen before. It's really just hitting the market at a certain time. You got to be correct. You have to be calculated. You have to reach out to your brokers, get some whisper prices, hear what people are buying these days, right? And guess what? You know who the buyers are these days? It's not the guys that walk around in suits. You're not going to have a suit and tie guy, I'm just coming and buying a property. It's just regular Joes like me and you, Tim, right? We buy properties together and we're just two regular Joes. And those are the type of people that are going to buy properties.
Yeah, you're right. I think a lot of people just assume that it's these, giant conglomerates, the big equity names, but a lot of it, and maybe it's just because you and I are in the space, but we see it's just other regular people like us who have the power to take these down by coming together, right? By coming together as both general partners, but then bringing our investors with us, who are those passive investors who are also just regular people with W-2 jobs who don't have the time to do what we're doing. So I think a lot of people just don't understand that it's not just these huge corporations that are taking down these apartment buildings. A lot of them are just normal people with normal jobs who are trying to get a better rate of return than they would in, say, like the stock market.
I mean, you said it. You hit it right on the nail. I mean, we started with a $3 to $4 million property when we were looking at things, and now we're approaching a $25 million property that we're under contract right now, right? So things have changed, but we haven't. We're the same individuals, and you're right. As you start to approach these larger deals, you will have investors that your LP investors that really make all of this happen, right? And it's a benefit for everyone. It's a benefit for us as GPs, and it's a benefit for the LPs investors, because every GP invests their own funds into the deal, because that shows skin in the game. So we're all working for the same cause. We're all working together to ensure that we get the best products, the best terms, and the best returns for ourselves, which are the GPs and the LPs as well.
Absolutely. And going back to loans, so for a long time, rates were only staying the same or going down, and no one could really even conceive of rates going up, it seemed like. So now that is certainly not the case, what do sponsors and investors, passive investors, need to be thinking about from the lending perspective?
All I got to say was a few years ago, like you said, the rates have been going down. It was the wild, wild west. It was like, yeehaw, let's buy anything and anything, right? You had a 2% cap, I'm buying it. You had a 1% cap, I'm buying it. People didn't care because the rates were so low. Now, things are not like that anymore. Now there is no wild, wild west. People are thinking, people are analyzing, people are structuring, right? They're retrading on every single deal because things are not making any sense now because rates are going up. But one thing that I've been noticing from the financing side, right? Because I see so many deals, not my own deals, but I see so many other deals. And also from my own perspective, which is my own personal deals, is that I'm seeing that now people are not over leveraging at this very moment, right? They're hitting about 65 LTC. So 65 loan to cost. You're all in at 65%. That means that they have to raise more money, but they're working against the market, right? In the event that the markets are still going to go where they are, where the Feds are introducing additional increases for the rest of the year, right? Because we're supposed to have about 3.5% increase for 2022. Will that happen? We don't know, but it's out there, right? It's out there. So banks are taking a step back. Banks are taking a step back and saying, hold on a second. We may not even lend right now because we don't even know what's happened. So number one, you're getting lenders that are backing out of deals right now because they don't understand what's going to happen with the market. Same thing for buyers. Buyers are saying, hold on a second. The pricing is not right, right? Sellers are saying, well, hold on a second. I want to sell, but I still want the best of the best, right? Because that's what sellers do. So in order to really achieve what you need to achieve right now, you have to make sure that you're not over leveraging yourself. Because when you don't over leverage, you're going to have lenders that are still interested in lending to you. Still going to give you the best products that's available, of course, because every lender is lending based on SOFR these days, especially if you get a bridge loan. You're being lent on the SOFR product, which is roughly about almost close to 2.5% as of today versus last year at 0.75. 0.75 versus right now at a 2.5. So don't over leverage. If you don't over leverage and you keep yourself at the 60 to 65% leverage, you're going to prosper even in this market right now because deals are being done. Smart guys, smart operators are taking everything over, but they're not over leveraging each other.
Yeah, that makes a lot of sense. Obviously, it's easy to get caught up when rates are low because it's it's cheap money, right? But when we talk about the rates going up, something that's been brought up a lot, I think, is rate caps, which is a phrase that I didn't even hear spoken, a year or two ago. So, can you talk to me a little bit about rate caps, how much more common that it is nowadays, and how expensive those are, and really what the impact is for that buyer and ultimately the passive investor?
So you ever heard the phrase, we're in the money? So as of right now, we're in the money. So that means that when you got a loan and the bank required you to purchase a rate cap, as of right now, you're in the money. One of the things that the insurers who sell you these rate caps haven't heard in the last 5 years. That has never happened. Right now, everyone's in the money. So what a rate cap does, it's a yield bond that protects you against it hedges you against any kind of increases in the rate. So when you close on a loan, you can get a strike price, which means it protects you over a certain increase in the SOFR. So for example, I'll give you an example with the Riley and the Berkeley, the property that we purchased together, right? We purchased that property for 18 million and we purchased a 1.7 strike price. Now back then, nobody knew that the rates are going to go to where they were. So our price point to purchase that wasn't really too expensive. It was roughly around 100,000, something within reason. It was 100,000, which is very normal for what it was. So if the SOFR would have increased by 1.75, above 1.75, and just keep in mind, as I mentioned earlier, SOFR is at 2.5% now. So we bought a strike price of 1.75. So if anything goes over 1.75, the insurer pays us the difference. So nowadays, if you wanted to close right now on an $18 million loan, every bank is going to require you a rate cap. You cannot close without it because it protects the lender as well. And in the event that you don't have enough to cover your debt, the insurer will step in and pay the difference. So I'll come back to what it was. 18 million, say you're buying it today, you're closing today with a 2.5% strike price, right? Or even a 1.75% strike price, you're paying over $800,000 today. And I'm speaking from experience because I had a client who just closed on a $35 million loan in Orlando, and he had to pay almost close to $1 million for a strike price.
Wow, that is such a huge difference in terms of making sure that deals pencil and make sense. Because I mean, if you're not taking that significant cost into account, that can just crush your deal.
It could be a deal killer. It was almost a deal killer. Now, if the banks wouldn't play ball and the equity investors wouldn't want to play ball, $1 million is a lot of money. Now you have to bring that money in. There is no loan on it. You have to pay for it, right? And it really does tweak your numbers. It really does tweak your numbers. And there's no way around it. Every lender at this very moment requires that you have to do it, that you have to buy it, and it's costly. And honestly speaking, I'm grateful that we were forced to buy it, because just like you, I wasn't really too familiar with what it was. It was like, hey, buy it or you don't close. So we had no choice, but we're so happy that now, well, we're not happy that the rates are going up, but you see what I mean? We're in the money, right? It's kind of it's like one of those phrases that you never want to use, but unfortunately you have to, because rates are only skyrocketing. So in conclusion, I would rather have the rates not go up. I don't want to be in the money. It increases our monthly mortgage payment every month. But once again, if you borrow right, and I've always said this phrase, and I've always said it, and I live by it, right? Debt is not to be feared. Debt is to be understood, right? Debt, you don't have to be afraid of it. If you borrow right, if you have good partners, if you understand what you're getting yourself into, you're going to prosper. You're going to do well.
Exactly. Debt is a tool, and you can certainly use it to your advantage. I'm not going to lie, it does make me feel a little bit better to know that you, someone who's, immersed in this stuff every day, wasn't really familiar with that concept, and that you even thought about it, because again, it's not something that was needed before or even considered. But I'm kind of surprised that the bank made us get it. But I guess, yeah, I'm thankful that they saved us from ourselves at this point.
Absolutely. Absolutely. It's exactly what's going to happen. And we're going to see, and we are probably going to see higher rates, this year, and possibly into the first quarter of 2023.
Yeah, and I expect maybe after that they'll start to slowly go down. But it's nice to know that at least when you do have that cap, that you don't have to worry about it once it's gone past that point that you're, I guess, technically insured to. So this has been great conversation. Obviously, we could talk about this all day, but I want to get into the turbo round. All right, so I'm going to ask you 3 questions in rapid succession, and these are questions that we ask all our guests just so we can get their unique perspective. The first one is, what is one red flag that every investor should look out for? And that can be a passive or an active investor.
Red flag. What is the one red flag that a passive or an active investor is actually going to look for? Okay. If you're just starting out in the business, I would say to stay away from tertiary markets, right? That can really bite you in the behind. If you're not from that certain area, right? Tertiary markets take a little bit of a hit than other markets, right? If you're trying to get a loan, many lenders are really backing away. It's usually the local lenders, and those local lenders are always requiring recourse. And I'm not sure that many of us operators want to take any kind of recourse option. So I would say that if you're just starting out, stay away from tertiary markets. Try to get it into the, I would say, B to A markets. Even though I do own properties in the tertiary markets, obviously I come from a financing background, so I understand. I come from an operations background, so I understand. But definitely stay away from the tertiary market, especially now.
Yeah, and just to clarify for some listeners in terms of what tertiary markets means, and correct me if I'm wrong, your primary markets are your huge cities, Los Angeles, New York, Miami, etc. Then you may have secondary markets, which are smaller but still very populous and have a whole lot of employers. Maybe something like Orlando or Tampa. I don't know if they'd be considered primary, but when we get into tertiary, okay. Yeah, when we get into tertiary, that's really those smaller towns with fewer employers, smaller population. So that's what we mean when we say tertiary. And the problem with tertiary markets, I think, is that you don't necessarily know if they're going to grow. And that's the population growth is certainly one of the main things that you want to be looking at when you're investing, because obviously the more people that are in that place, that's the more people that need somewhere to live. All right. The second question, what is a myth about this business that you would like to set straight?
I love that one. Well, I can tell you one thing. It is not a get-rich scheme type of thing, right? You're going to have to work. There is no getting rich here. It is tons of work. Nobody here is looking to get rich. We're here to build wealth. It is never now. It is for the future, right? So you're going to have to sweat. You're going to have to stress. You're going to have to lose sleep. You're going to have to lose some personal relationships. I'm coming from experience. I work my butt off, right? And it's all day, every day. And losing sleep, working with everyone, countless meetings and Zoom calls, a lot of learning, still reaching out to people, still trying to get feedback from everyone else. It is work, work, and work. There is no get rich thing here. It doesn't exist.
Yeah, I definitely agree with you there and identify with that. You have to have a long view coming into this, because if you come into it, especially if you're talking about being an active investor, a GP, you can't think that, I'll knock this out in a year or two and I'll be set for life. That's just not how this works. These are long-term deals. For the most part, you may have your one-offs here and there that you turn around in 18 months, and those are great. But most of them, you're looking at a 3 to 5 year hold on these deals, and it's multiple deals, a lot of time looking at each one, because you got to do it right. Because if you do it wrong, it could cost you personally tens of thousands, and in some cases, hundreds of thousands of dollars.
Absolutely. And when I meant to say that, it's not a get rich type of thing. And I meant to say that more or less that once you get into it, you'll understand that it's not about the now, it's about later, right? You're building for the future. And it will all come at a later date as you start to progress.
Yeah. And so the last question I have for you is, what does success look like to you?
Very interesting question. To me, I would say success is health, right? For me, it's important for me to be healthy, right? To keep your mind sharp. For me, it's never about the cars or the houses or anything. That doesn't value who I am as an individual. To me, is I want to make sure that I'm healthy. I want to make sure that I'm catching up on my sleep. I want to make sure that I'm entertaining my mind and my brain, and that I'm reading, and that I'm educating, and that I'm helping other people. That's what really shows who I am as an individual.
Yeah, and that's something that we hear when I ask that question. This good health, continuous learning, and in giving back. Those seem to be three themes that run across almost every guest that comes on the show. All right, Russell. Well, hey, this has been great. Please tell our guests how they can get a hold of you, and if you have anything else that you would like to share with them.
Absolutely. You can reach out to me at russell@csg-ny.com. And I'm sure, Tim, you're going to have all of my information on there as well for everyone to see. But you could also visit our website at www.csg-ny.com and visit our operations website, which is mtninvestmentgroup.com. And you can see all the properties that we're working on, and even others that are currently in contract and open to the public should anybody look to invest and grow their real estate portfolio. So those are the two websites, and my phone number, of course, 917-559-1820. Feel free to reach out. No question is a wrong question. I am always here and here to help.
Awesome. And we'll certainly have all that information in the show notes for our guests and in the YouTube description. Well, again, thank you for being on, not just for the great conversation, but all the knowledge and value that you've provided to the audience. I want to thank you for coming on, and I look forward to seeing you do even bigger things on your journey to multifamily millions.
Thank you so much, Tim. I appreciate you having me. Have a wonderful day.
You too.